Good afternoon. We'd like to welcome you to the Gabelli Fund's live webcast series. Today, we're excited to be following the Federal Reserve's decision to cut interest rates and host a timely webcast titled, Why You Haven't Missed the Gold Rally. We're joined by Caesar Bryan, portfolio manager of the Gabelli Gold Fund. Caesar is one of the most tenured gold equities managers within the space. If you have any questions during the presentation, you can enter them in the Q&A box at the bottom of your screen. I'd like to now turn the call over to Caesar.
Thanks very much. Welcome, everyone, and thanks for joining us on the on this call. Just by way of introduction, my name is Caesar Bryan, and I'm the portfolio manager of the Gabelli Gold Fund and have been since the start of the fund in 1994. And I'm joined today by my colleague Christopher Mancini, who is a dedicated gold analyst and has been on the following gold equities for about a decade. And our biographies, if you want to know more details, are on page 13. With that, we'd just like to get started right away and go to show you the slide with the gold price performance over the last decade. And as you can see, the gold price really has done something quite interesting, certainly from a technical standpoint, breaking above the sort of $1,375, $1,400 level. It's really been in a trading range for the last 6 years. The low in gold was around about December 2015, when the Fed actually first started to raise interest rates. So we think there's a message in this. And of course, with gold, there are no earnings, no dividend. It's just simply money. And this move, we think, is significant. And so the reason is, we believe, is that there's really been a change in central bank monetary policy. There was never a normalization in global monetary policy following or in the wake of the global financial crisis, even though the Federal Reserve raised rates and ceased purchasing assets. Overseas central banks really never tightened in any meaningful way, certainly in the major central banks. And now, if you look at what the ECB has said, they are about to undertake further easing. Remember, their deposit rate is negative 40 basis points. And the Fed today, as we can see, has just cut rates 25 basis points. So the importance of this slide, which is really extraordinary to think that today is the highest level at $13.8 trillion of negative yielding bonds. So that's a good, it's almost 75, 80% of the US economy, negative yielding bonds. So really, governments are taking money away. We are investing in government bonds and we're going to get back less. 10 countries have negative 10-year yields. The Swiss government, you pay to give the Swiss government money for 30 years. So in short, there's really no end to the global monetary experiment. And this in some respects is somewhat a sort of dysfunctional monetary system that we have or conditions right now. And of course, the reason is that there's so much debt that it's the policymakers are very fearful of having real interest rates with so much outstanding debt. So that's the backdrop, and we think that's going to be, remain fairly favorable as central banks embark on further monetary ease. So why gold equities? And that's what we deal with. That's our job. We invest in gold equities. First, they provide leverage to changes or movements in the price of gold, up and down, of course. You can get growth. Companies can grow their reserves, production, earnings, and importantly, you can buy gold at a significant discount in the ground, ranging from a few dollars for a gold development or a company that has resources to $100, $250 of per ounce of gold in the ground, relative, of course, to the price of 1420. And lastly, and this we believe is going to become more relevant in the future, gold equities have the ability to pay dividends. So if and when the gold price rises, earnings increase, companies will institute or raise their dividend payout. So there'll be an income component to gold equities, we believe, going forward. We think gold is a financial insurance policy that has become less expensive over the last decade or so. Remember, gold is no one else's liability. It's always liquid. So, and it doesn't involve shorting. You go long gold or gold equities, and that's a form of, we believe, of insurance for for an investment portfolio. Unloved, obviously, even though the gold equities have doubled from the low, they're still over 60% from their high, and the gold price is over 25% from its high. And of course, it's still a tiny sector. The XAU index is a Philadelphia gold and silver index with a capitalization of under $200 billion, and actually smaller than smaller than Pepsi at 185 billion. Just moving on to the valuation of gold equities. This is just one metric that shows that the gold stocks are cheap relative to their history, and we actually think they're cheap relative to the gold price. And we'll talk about that in a minute. Just in summary, non-correlated, and we think the gold equities are inexpensive and actually provide an opportunity. And maybe Chris would just like to comment briefly on where we are in terms of gold equities and what we believe is their improved outlook.
Thanks, Caesar. So, hi, I'm Chris Mancini, the analyst for the fund. Just the big picture is that the price of gold has declined it declined substantially from its high in 2011 at around 1950, and then down in 2013. The price really collapsed. 2012 was kind of flattish to down, but 2013 it really collapsed. And then it bottomed in 2015, and at around, I think it was 1,050 was the low. And throughout that time period, the gold mining companies made a lot of efforts to cut costs and fix their balance sheets, which had been levered. They had been building mines. And so you have a scenario now where the all-in sustaining cost to produce an ounce of gold has gone from around $1,100 an ounce to today around $950 an ounce. And balance sheets are largely fixed. And also, there's the companies really haven't been building lots of new mines, so that should be helpful from a supply perspective down the road as mine supply. It's started to roll over now. It's starting to decline a little bit. So we could be in a scenario where demand increases and supply declines, and then also again, the companies are largely fixed and are starting to generate a lot of free cash flow now. And as Caesar mentioned, we expect to start to see dividends increase if the gold price stays at the current level or increases. And just quickly, it says optionality there too. If as the gold price rises for certain mines, there could be mineralization which is outside of our current mine plan, which is not economic currently, or say not economic at like $1,200 an ounce, but it becomes economic at say $1,450 or $1,500 an ounce, and that's not being priced into the valuation of gold mining companies at all.
Thanks, Chris. So just a couple of words on the fund that I manage. So the Gabelli Gold Fund, and this is the iShare symbol, GLDIX. Just a word about what we do. Well, we're fundamental bottom-up investors, and we actually use a variety of valuation methodologies to pick the gold equities that we invest in. You should know that this fund is always fully committed to gold equities. We're long-term investors. There's no hedging in the portfolio, and as we're long-term patient investors, the portfolio has a very low turnover rate. Chris, maybe you should just highlight very briefly what we look for in the equities, in the gold companies that we invest in.
Okay, thanks, Caesar. Yeah, so we look for companies that have the best assets, the best managements, good valuation, and we do that from a bottoms-up perspective. One example is Detour Gold. Detour has the biggest gold mine in Canada. It's a single asset company, biggest gold mine in Canada, called the Detour Lake Mine. We expect it to produce around 650,000 ounces per year on average for the next 21 years. I visited the mine a couple times. The company has had teething issues as it started up. It went from a junior exploration company into an actual production company. So the asset is very good. It's in a great jurisdiction, lots of optionality, and the management has recently changed. So we think that this is a very good new management for the company. We think that they're going to optimize the asset, and as that happens, the stock's traded up as the gold price has gone up. It's traded up a lot. It's up around 70% since the gold price has started to move at the end of May. But we think that it'll continue to go up and to re-rate higher as this very good assets gets optimized by this new management. So again, assets management, valuation, we look at discounted cash flow of the mines going forward, and then we try to figure out what the market might be missing. And in this circumstance, we think that the market's pricing in a low probability of mine optimization, and we think that there's a high probability that the mine will be optimized.
Yeah, thank you, Caesar. And as a reminder, you can enter your questions in the Q&A box at the bottom of your screen. Caesar, do you want to start off with the first question there?
Yeah, actually, yes. Yes, I will, because this is one question or from one person, but actually is a number of questions. So we're going to do this very quickly. I'm going to ask the questions. Chris is going to answer them in very short order. And then to the extent I disagree with anything, I'll have a chance of rebuttal at the end. So let's go. The current move on gold does not look like it is correlating the ways we've come to expect. What's different?
Well, I think that it has been correlated in that it's the gold price is moving based on a view that there's going to be currency debasement, and there is currency debasement in terms of negative rates, as Caesar was mentioning. So I don't think it's really that different. It's the gold price is moving based on currency debasement.
How will we know when the music ends?
I think that we'll know it when we start to see gold really, really rally.
Central banks are among the largest holders of gold, and gold is their natural adversary. Will they suddenly change that tune?
No, I don't think so. They're going to keep printing gold and keep printing money, and central banks have actually been buying gold globally.
What about other big holders of gold? Indians, China? Is the current move on gold related directly or indirectly to the emergence of digital currency as a disruptive force? Sorry, Chris, that's two.
India, China, their base load demand growing a little bit each year. Expect that to continue to be the case. Digital currency, I don't think, is affecting the gold price.
Will digital currency change the rules for monetarist-minded policymakers?
I don't think so.
Is gold telling us more disruption is on the way?
Yes.
That's it. I agree with everything he said. Can we move on to the next question?
Sure. The next question comes from Darwin in Lancaster, Ohio. When will the global central bank's debt bubble implode? And in your opinion, what are the price implications for gold?
So Caesar just pushed the microphone in front of me. I think that I don't think it'll implode. I think that what we're seeing is, so we won't see an implosion. What we're going to see is a monetization, and that's what's happening. They keep on printing money to buy more bonds, and the Fed's on the way to do that, and that'll cause inflation down the road, and that's why gold's up.
Yeah, and that just ties in with what we said in the presentation. We just can't afford real interest rates at the moment because of the high debt levels. Thanks. Next.
Matthew in Southfield, Michigan. Does gold still worry about inflation, government debts, deficits, and the U.S. dollar?
Yeah, of course. These are all things that impact the price of gold. Absolutely. Next.
Next one is from Jason in Fort Lee, New Jersey. Does the fund invest in any gold royalty companies, and what are your thoughts on the gold royalty companies?
Yes, we've owned gold royalty companies for many years. Franco and Euro Nevada were the first royalty companies that we invested in. Then they disappeared, and then came back. They were merged into Newmont, and then Newmont spun out Franco Nevada, and we were investors at the time of the spin-off. Since then, we've invested in Royal Gold, Silver Wheaton, and Maverick. So yes, it's been an excellent subsector of the gold equity market for gold investors. However, in an explosive bull market for gold, those stocks will underperform because they don't, of course, have the leverage, the operational leverage that operating companies have. Next
one comes from Rod in Northbrook, Illinois. Thoughts on Barrick Gold CEOs and the company's strategy?
Yes, we've been in. Mark Bristow is the CEO, the new CEO of Barrick Gold. We first invested with Mark Bristow when the predecessor company that he worked for, Randgold Resources, was spun out of Rand Mines, and all it had was exploration properties in West Africa, and we were involved at the initial spin. So we followed his career for a while, and Chris, why don't you have a comment on where Mark is now in the process of at Barrick?
Yeah, so Mark took over as the CEO of Barrick when Randgold and Barrick merged. The merger closed on January 2nd of this year, and he's done a lot. So the first thing he did, one is he's cutting costs across the business, number one. Number two, he essentially forced a joint venture between Barrick and Newmont's Nevada operations. That Nevada JV, that deal closed and was consummated, I think, like 4 weeks ago or something like that. So that has the capacity, we think, to be the most highly valued gold mining entity in the world, called Nevada Gold Mines. So he's integrating those Nevada assets. And then there was also a problem with Barrick owns 65% or so of the shares outstanding of a company called Acacia, which had been called African Barrick. These were gold mines in Tanzania. The government got upset with Acacia relative to layoffs and things like that at their mine sites, and the fact that they weren't paying taxes, had big tax losses. It's a long story, but anyway, Barrick has just agreed to consolidate Acacia. So now Barrick will own 100% of Acacia, will own these Tanzanian mines. So Mark's going to go in, he's going to optimize the Nevada operation, the Nevada JV with the Newmont mines. He'll optimize these Tanzanian assets. And we think he'll do a lot more in terms of, and so there's a lot going on there in Barrick, and it's pretty exciting. And it's the biggest position in the gold fund now.
Thanks. Next.
Yep. We have a couple questions more specifically on the portfolio. Is there a market cap of the fund that you'll allocate to junior miners? What market cap do you favor, whether it's small, like Kirkland Lake Gold, or large like Newmont? And are there any countries you refuse to invest in?
Well, there's a lot there, but in terms of portfolio construction, we invest across all market caps, and we invest on a global basis. We tend to limit to about 15% as the maximum in development and early stage companies. And at this point, we're actually way below that. So we consider liquidity and a number of different metrics. But now, in terms of countries we don't invest in, I mean, risk comes in many forms, and there are very few absolutes in this industry. But right now, we tend not. Well, we do not have any investments in, for example, Russia, which does have actually a couple of very high quality gold companies.
Great. One more here from Andy in Annapolis, Maryland. Any thoughts on the current M&A market?
Yes, I mean we've had two, major deals, and we think there are going to be more transactions in the future. First, a number of there are going to potentially be a number of sales from the Newmont Gold Corp and Randgold Barrick transaction, which Chris just referenced. So there could be some sales of assets from those combinations, and then later on, as the bull market matures, the major companies will be looking to add to their reserve base to in order that they can grow through the next decade. So yes, I mean we think there will be more transactions.
Great. I think that's all the questions that we have. Anything else from your end, Caesar or Chris?
No, I think that's it. Just at this point, we'd just like to thank you very much for joining us today to hear some of our thoughts on the gold and gold equity sectors. Thank you very much.
Investors should carefully consider the investment objectives, risks, charges, and expenses of the fund before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com.